Hey everybody, John Murphy, CSSI. I hope you're doing great. I wanted to introduce basically an analysis that I've created for studying tenant improvements. And one of the things that I have seen as of late, and we've been studying a number of tenant improvements, which has been interesting. The building owners want it studied, and the CPAs want it studied, but not enough people are studying these improvements. And one of the things that I've seen is that when we get these cost segregation studies back, it's something like, I don't know, 30 to 50% of the improvement, the tenant improvement, the capitalized improvements, were 5-year class life property. And what happens is usually a building owner will do these improvements. It might be, hey, to get a new tenant in, they strike a lease deal and they agree, I'm going to spend $300, $400, $500,000 to build this out for this tenant. It gets worked out in the lease. The building owner tells his CPA about it. CPA says, okay, it's qualified improvement property, that's 15-year class life. We're going to mark that down in the depreciation schedule, and in 2024 we're going to take 60% of that, and then the remaining 40% you'll take over the next 15 years. But what I'm saying is that those improvements over $200,000 probably should be studied, or at least evaluated to be studied. But I never had a way to be able to show that to a CPA or to a building owner to say, yeah, I think it's going to be worth it. If it's an office build out, it might be 30, 35, 40% 5-year class life property. If it's a restaurant or a coffee shop or something, it might be 35 to 50% 5-year property. Who knows? But you're leaving money on the table, I believe, and I'm going to show you that based on this analysis that we just created here. And so I want to run through it here for you to see it. I'll publish more information on it here shortly, but let's take a look at this. This is 2024, 60% bonus depreciation, okay? And I'm running this on a $400,000 improvement that's done to a property. The tax rate's 32%. I tend to run these at 32%. I don't like to overstate that number, but if the tax rate, the effective tax rate, or the marginal tax rate for the building owner is higher than that, this benefit is going to be better for them. We're showing 35% 5-year class life property, and I've also thrown in here about 2% might get identified as 39-year property. When we study these properties, sometimes there might be 2 to 3 to 4% that I've seen anyway that gets identified as 39-year property, so that would not be QIP or 5-year class life property. But a lot of times it's also 0. So anyway, I put 2% in here to be conservative. Let's say this study costs $3,500. I'm just ballparking it here so you can see that. And then we also have diminished value, because there's value, I believe, in doing cost segregation, not only on the front end, the early years of the life of the ownership of the property, but also when you go to dispose of the property. And you're always going to need to talk with your own CPA and tax advisor to understand how it is you're going to dispose of this. You can do a 1031 exchange, or you're just going to sell it and pay the taxes on it. As far as recapture tax, every CPA operates differently. Building owners operate differently. I'm not giving you tax advice here. Just telling you what I hear from other building owners and CPAs that I talk with. So what I'm showing here, I think, is probably fairly middle of the road. It's not particularly aggressive. I know some CPAs are a lot more aggressive than the numbers that I'm showing you here. So if that were the case, if you were more aggressive on diminished value, you're going to do even better by doing cost segregation, okay? So let's take a look at this. There's a lot of information here. Sorry, I've got a lot of depreciation in this so you can see it. But here's the main things that I want you to look at are these green columns. Cumulative net savings, cost seg versus not cost seg. So again, your CPA, usually they're just going to take that $400,000, put it on your depreciation schedule, take $240,000 of that in 2024, and give that bonus. That's bonus depreciation. You get to write that off that year. The rest of it carries forward for 15 years. What we're saying in doing a cost segregation study, we're going to give you 5-year property and 15-year property. There might be a tiny little bit that's 39-year property, could be 0. But so we study it, we delineate it, reclassify it. And so we're saying that, hey, year 1, it's a net negative for you. Okay, you're paying for the study. It's not a benefit year 1 for you to do cost segregation. Okay, year 2, it's almost neutral, and it becomes positive when you look at it if you had to dispose of the property in year 2, which most of you will not. And then year 3, 4, 5, 6, 7, 8, it starts becoming positive. Right, it's net positive $2,500, $5,700, $8,900 in cumulative tax savings after accounting for paying for the study itself. Then when you go to sell the property, okay, this can help with diminished value and trying to figure out what's the value of all these components to your property, because now they're used. They don't have quite the value they did when you originally put it into service. So there's a way for you to discount that, if you will. Again, consult with your own tax advisor on this. And so you can see you can get an additional savings there. And so you end up with a total net tax savings, okay, on that property. And it might be year 5 and 6. It could end up being $15,000 to $20,000 on this particular project, studying a $400,000 improvement. And this doesn't even account for if your project qualifies for partial asset disposition. Okay, so that's a whole nother category. If it does, okay, this is going to become a whole lot more valuable for you to do this. I want to show you just for a second, because we've done some of these that are higher at 45, 48%. Let's look at the savings here. If it ended up being 45%, we don't really know for sure, right? That's the really hard thing when we go to do an estimate on an improvement. We're guessing a bit, right? I'm just telling you from my experience, a lot of these improvements are coming back 30, 40, 50% 5-year class life property. Okay, if you were to study this one and 45% of it came back as 5-year class life property, you can see your net positive after paying for the study right away on year 2, and the savings starts to become quite significant for you for studying this property. Then if you come over here and you look at, hey, well, I'm going to dispose of the property, say in 6 years, and I would like to put a diminished value on this property, okay? Because we've reclassified it, it's going to be easier for you and your CPA to get this figured out. You're looking at cumulative tax savings potentially of $20,000, $30,000, okay, on this little study that cost $3,500 on your $400,000 improvement. So anyway, I think it's significant. I'm looking for ways to try to help squeeze out everything we possibly can out of these buildings and these improvements. I will tell you that probably more than 95%, it might be 97, maybe 98% of the improvement projects are not studied. And I know they're not studied because most of the CPAs and the building owners don't reach out to me to talk about studying their improvements. There have been a few lately, and it definitely makes sense to do it when bonus depreciation is at 60%. It's a little tougher when it was at 80%. There's still some value to do that, especially when you go to sell the building. Okay, but at 60% bonus depreciation, it really does make sense. If you've got a project that's $200,000 or more, it really should be looked at studying. I work all over the country. My name is John Murphy. I happen to work for a firm called CSSI. I run a blog at Cost Seg Building. You can find me on the socials at Cost Seg Building. Connect with me on LinkedIn. Happy to chat with you and consult and run some numbers for your particular project. Let's see what it looks like. And I can give you some different scenarios. We can run some different scenarios for you. I can print this off so you have a nice PDF, and you can look at it and say, hey, what happens if it's 30%, 40%, 45%? What does that tax savings look like? It's going to be a no-brainer like cost segregation is. It's just a math equation, okay? You figure it out. Can you use it or not? We always recommend you consult with your tax advisors to make sure this works for you. But happy to talk you through, give you some numbers, and let me be of help and see if we can squeeze something else out of your building and your project. Take care. Bye-bye.